Many people believe real estate wealth requires buying buildings, managing tenants, and handling constant maintenance. But there is another system that allows participation in property income without direct ownership. Real estate investment trusts offer access to real estate markets through a structured and regulated approach. In this video, you will understand how this system works, why it exists, and how investors use it to build long-term wealth without owning physical property. Like and subscribe to continue learning how modern wealth systems quietly operate. 1. What real estate investment trusts are. Real estate investment trusts are companies that own, operate, or finance income, producing real estate. Instead of purchasing property directly, investors buy shares in these trusts. The trust collects rental income from properties and distributes earnings to investors. This structure allows individuals to access large-scale real estate assets that would otherwise be unreachable. Real estate investment trusts transform property ownership into a shared investment model. Investors benefit from income and value growth without managing buildings. 2. How income is generated. Income within real estate investment trusts comes primarily from rent paid by tenants. Properties may include apartments, offices, retail centers, warehouses, or healthcare facilities. Rental income flows into the trust and is distributed to investors regularly. This creates a predictable income stream similar to traditional rental property ownership. The difference is that management responsibilities are handled professionally. Investors receive income without direct involvement. Over time, rental growth improves distributions, making this system suitable for income-focused investors seeking stability. 3. Professional management advantage. Real estate investment trusts are managed by experienced professionals. These teams handle acquisition, leasing, maintenance, and financing decisions. This removes operational complexity from individual investors. Professional management improves efficiency and risk control. Properties are selected based on performance potential rather than emotion. Scale allows better negotiation and diversification. Investors benefit from institutional-level decision-making without needing personal expertise. This structure transforms real estate into a passive wealth-building tool rather than an active business. 4. Liquidity and accessibility. Unlike physical property, real estate investment trusts offer liquidity. Shares can often be bought or sold easily through financial markets. This flexibility allows investors to adjust exposure without selling buildings. Accessibility is another advantage. Investors can start with smaller amounts of capital. This lowers the barrier to entry for real estate participation. Liquidity reduces long-term commitment pressure. 5. Diversification benefits. Real estate investment trusts provide diversification across properties, locations, and sectors. Instead of relying on one building, investors gain exposure to many assets. This reduces risk from vacancies or regional downturns. Diversification stabilizes income and performance. Trusts may hold dozens or hundreds of properties. This scale smooths returns over time. Diversification is one of the strongest advantages compared to owning a single property. 6. Relationship with market cycles. Real estate investment trusts respond to market conditions but benefit from long-term property fundamentals. Short-term price movements may occur, yet income remains tied to rental performance. Over time, property demand supports growth. Investors who focus on long-term holding benefit from income consistency. Market cycles affect pricing, but underlying assets continue generating value. This balance makes real estate investment trusts suitable for disciplined long-term investors. 7. Inflation and income growth. As inflation increases, rents often rise as well. This supports growing income within real estate investment trusts. Properties adjust to economic conditions while distributions increase. Inflation reduces cash value, but strengthens real asset income. This provides protection over time. Real estate investment trusts allow investors to benefit from this adjustment without owning property directly. Income growth preserves purchasing power during inflationary periods. 8. Tax structure and distribution rules. Real estate investment trusts operate under specific regulatory rules. A large portion of income is distributed to investors. This structure supports regular income flow. Tax treatment may differ from other investments depending on jurisdiction. Understanding these rules helps investors plan long-term. The distribution requirement ensures that income reaches shareholders consistently. This rule-driven structure creates transparency and predictability. 9. Risk considerations. Like all investments, real estate investment trusts carry risk. Property market downturns, interest rate changes, and economic shifts can affect performance. However, diversification and professional management reduce individual asset risk. Investors must understand market sensitivity. Long-term focus and portfolio balance help manage volatility. Risk exists, but is structured and visible. Informed investors integrate these trusts thoughtfully into broader strategies. 10. Real estate without ownership. Real estate investment trusts allow participation in property wealth without direct ownership. There are no tenants' repairs or mortgages to manage. Investors gain exposure to income appreciation and diversification through a structured system. This approach suits those seeking simplicity and scale. Real estate becomes accessible, efficient, and passive. This model proves that property wealth does not require physical ownership to be effective. Real estate investment trusts show that property wealth can be built through structure rather than ownership. By combining income diversification and professional management, this system opens real estate to a wider audience. Understanding how it works allows investors to participate confidently without operational burden. Like and subscribe to continue learning how modern investment structures turn traditional assets into accessible, long-term wealth systems.